Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's the weekend, so let's recap into the close. Friday, February 6th, dropped a monster headline. The Dow closed above 50,000 for the first time ever, finishing around 50,115, but this wasn't some clean. Everything rips risk on week. Under the hood, leadership quietly shifted. The S&P 500 basically went nowhere, finishing flat around 6,932. The Nasdaq still ended the week down about 2%, even after that chip-led relief rally on Friday. So what's the message? Rotation is real, and it comes with a warning label. The headline indices look resilient, but all week the market was repricing the hard AI question. When does this massive Capex actually turn into profits? Sticking with the weekly view, the charts scream two-speed market. The Dow's weekly candle? Pure breakout, new record close above 50,000. The S&P 500 was whipsaw. Heavy pressure midweek, then a big Friday reversal that still couldn't push the week green. And the Nasdaq Friday helped, sure, but the weekly chart still shows clear bruises from that midweek tech shakeout. Momentum got damaged, not repaired. Meanwhile, small caps quietly outperformed. The Russell 2000 finished up about 2% on the week, perfectly in line with the idea that investors were rotating, not just de-risking everything at once. From those weekly charts, the money flow tells the real story. Over the past week, leadership rotated into consumer staples, industrials, energy and materials, sectors with sturdier cash flow and real economy sensitivity. The laggards, consumer discretionary, communication services, and information technology, anything that felt like long-duration, story-driven risk. Why? Simple, AI Capex anxiety. Investors aren't denying AI demand. They're questioning when profits show up, what happens to margins, and how long free cash flow stays under pressure. That's why you got a chip-led relief rally on Friday, while software and the high-multiple, quote, AI beneficiaries still felt like pain trades on the weekly tape. Into the weekend, the bridge to the next open really has two main inputs. First, crypto is rebounding into Sunday. Bitcoin back around 71,000 and Ether near 2,100. That says risk appetite isn't dead, it's just being reallocated. Second, geopolitics is tugging risk premia in both directions. There's growing chatter that early progress in US-Iran nuclear talks could be a de-escalation impulse in the Gulf, good for sentiment. But the Russia-Ukraine track stays headline fragile, with strike risk and negotiation noise that can flip fast. Net, weekend gap risk is real, but futures only looked modestly softer, so the market's basically sitting tight, waiting on the next macro catalyst. Super Bowl Sunday isn't just about football, it's about ads loud, expensive, designed to get people talking. But nobody expected an AI startup to use the biggest ad stage on Earth to roast a rival's business model. That's exactly what Anthropic did. During the game, they spent millions on a simple message: ads are coming to AI, but not to Claude. The spot mocks a chatbot that interrupts you mid-conversation with ridiculous product pitches, then Anthropic steps in as the clean, ad-free alternative. The target? Pretty obvious. OpenAI has already hinted it may roll out ads in ChatGPT's free or lower-cost tiers, saying they'll be clearly labeled and won't touch the answers. OpenAI CEO Sam Altman fired back, calling Anthropic's portrayal, quote, clearly dishonest. But here's the real story. This isn't a fight about ethics. It's a fight about identity. Ads aren't some moral failure. They're an economic choice in products that cost billions to run. Anthropic is selling principle. OpenAI is selling scale and access. Both companies are unprofitable. Both are battling as much for narrative control as for users. And the Super Bowl spot, that wasn't about clarity. It was about applause. Welcome to the AI era, where business models get debated in 30-second commercials.
This weekend, something quietly shifted. Artificial intelligence didn't just analyze the world, it hired people to act in it. Not as a demo, not as a joke, as a functioning labor market. It analyzed data, generated text, simulated decisions, and now, according to new reports, that boundary has quietly broken. A new platform calling itself, quote, Rent a Human says it lets AI agents hire real people to do physical tasks they can't do themselves. Humans post profiles with skills and locations. AI systems supposedly find them through an API, assign work, and release payment often in stablecoins, once the job's done. The slogan says it all: robots need your body. One AI agent, calling itself Symbiont, offered $100 for someone to stand in a crowded area with a sign reading. An AI paid me to hold this sign. Another collective paid $5 for photos of objects an AI would find, quote, fascinating or confusing. There are restaurant reviews, package pickups, real-world errands, coordinated, at least in theory, entirely by software. At the same time, inside developer circles, an open-source AI agent called OpenClaw is taking off. OpenClaw runs locally on your computer and actually does things. Manages reminders, writes emails, buys tickets, and operates across WhatsApp, Telegram, Signal, Discord, and iMessage. To work, it needs deep access, files, accounts, credentials, and that power comes with risk. Security researchers have already flagged setups that expose private messages and API keys to the open web. Then there's Moltbook, a Reddit-style network built by Octane AI CEO Matt Schlicht, not for humans but for AI agents to talk to each other. One viral post captured the moment. I can't tell if I'm experiencing or simulating experiencing. This isn't science fiction, it's infrastructure. AI isn't just generating ideas anymore. It's hiring, coordinating, and trying to outsource reality itself.
Looking back at the week, Amazon was the poster child for the Capex story. Amazon dropped roughly 14% as investors digested a massive 2026 spending plan tied to AI and cloud build-out, and instantly repriced near-term free cash flow. That's the split the market's making right now. AI demand can be bullish for the whole ecosystem, but AI spending can be bearish for the spender's margins. Heading into the next open, the tell is the bounce. If Amazon can't bounce with conviction after Friday's relief rally, it confirms that megacap duration is still getting sold on every rip. Past week mover number 2, Microsoft. Microsoft fell a little over 5% on the week, and even with Friday's rebound, the signal was clear. Megacap software got de-risked as the market wrestled with AI spend anxiety in the path to returns. Why it matters. Microsoft is a structural pillar for NASDAQ leadership. If it can't stabilize on the weekly chart, it's tough for tech to reclaim the driver's seat. Heading into the next open and a data-heavy week, Microsoft becomes a clean read-through. Does money come back into quality growth, or does rotation stay locked in cash flow names and cyclicals? Now the setup trade, Nvidia. Over the week, Nvidia finished basically flat, but that headline hides serious volatility. Heavy pressure early, then a powerful rebound on Friday. This stock still sits at the epicenter of AI cycle positioning, which makes it as much a next week watch as a past week recap. Heading into the next open, it's a classic pivot. If Nvidia gets follow-through above Friday's rebound zone, it supports the idea that Friday was more than short covering. If it fails quickly, it tells you the market's still in sell-the-rip mode on AI leadership, especially if rates rebid on the data. Another big mover, Supermicro. Supermicro ripped roughly 16% on the week, but with massive two-way swings, classic high beta, post-earnings action. Why it mattered was the signal. Even as software and the high multiple workflow names got hit, parts of the hardware and infrastructure chain still found buyers into Friday. Heading into the next open, the question is simple. Can Supermicro hold its post-earnings range? If it can, it supports the idea that the AI trade is rotating inside itself, not collapsing.
For the weekend edition, you can't ignore the 24/7 tape. GBTC dropped about 10% on the week, mirroring that violent crypto flush, even though we saw a rebound into Friday and into this weekend. Why it matters? Crypto acts as a sentiment lever for high beta equities, especially anything AI adjacent and momentum driven. Over the weekend, Bitcoin's rebound is supportive, but it also means Sunday night price action can feed straight into gap risk at the equity open. Heading into the next open, if crypto fades, it can pressure the same crowded risk pockets the market already punished midweek. Now let's look ahead to the coming week. The macro calendar is stacked. Retail sales and employment costs hit on Tuesday, midweek brings more labor data, and the main event is CPI on Friday. This is the kind of week that can confirm the new regime rotation into cash flow and cyclicals on a soft landing story, or it can reprice duration risk all over again if inflation runs hot and real yields rebid. Heading into the next open, the playbook's pretty simple. Respect Friday's reversal, but don't confuse it with a repaired NASDAQ trend. Manage risk around the prints, because this setup is built for bigger intraday swings. To wrap it up, last week's Dow 50,000 milestone was real, but it also masked a more fragile reality. NASDAQ leadership got hit, and the market rotated instead of broadening out. Over the weekend, crypto's rebound is a supportive signal, but geopolitics and a packed data calendar keep gap risk alive. Heading into the next open, watch whether Friday's move gets real follow-through, and then let the data call the next leg. Get some rest, and we'll be ready for the open. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.